Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. Today on the Mutual Fund Show, I think we're going to focus on the question that is on every investor's mind. It's that time of the month when a lot of SIPs go out. It's also that kind of a day when portfolios are looking bruised and battered. It's not just the Indian markets that have seen a sharp cut, but it is a global kind of an impact that we're seeing. So a lot of questions right now, right, that we've been talking about all day. Is this something that's going to persist? Is the US going to go into a recession? What happens to India? What happens to global markets? What happens to the Nifty? But in this particular show, we're going to be talking about what happens to your portfolio. Is this a good time to buy the dip? Because remember, Indian retail investors are also very smart at doing that. What is the kind of strategy that you should employ in order to navigate the ongoing market sell-off? There are two ways of looking at it. In fact, various views on what you should do. And we're going to be speaking today with Hemant Rustagi, CEO of Wiseinvest, and Pankaj Mathpal, founder and CEO of Optima Money Managers. Welcome to both of you. Thank you so much. Pleasure to speak with you on the Mutual Fund Show today. Hemant, let me come to you. It's a tough day on the street for investors of every kind, but for mutual fund investors, I think at the end of the day, they would be the most secure knowing that their SIPs are going out on time. Is that the way you should look at it?
Oh, absolutely, Tamanna. I think you're right. This is a tough day. And in fact, this is the third time in the recent times that we are seeing such a day. We saw that there was a deep cut in the market when the election results were announced, and also on the day when the budget was presented. And this is the third time. And as you rightly mentioned, I think this time the reasons are slightly different. The more basically global reasons than the domestic reasons. But you're absolutely right. If you analyze the way the investors have been investing in mutual funds in our country in the last few years, most of them are investing through SIP, which means that they are following a disciplined approach. They are committed to kind of hold this money for a longer period. And I think one important thing is that most of them have aligned these investments to their goals. So they have much more clarity in terms of how long they can hold these investments. So I think any investor who has kind of been investing in a disciplined manner has done the right thing by selecting funds as in line with the asset allocation. I think I would say that those investors need not really worry about the kind of deep cut that we're seeing in the market, because we know that volatility in the market is a natural phenomenon, and these times will come and go. But only difference this time is that the reasons are global, and we need to really wait it out whether the recovery that we saw in our earlier two occasions, whether we'll see that kind of recovery or it's going to take some more time.
Pankaj, let me come to you. Wait it out is some of the advice that is coming in. What about the question of buying the dip? Look at the next few days and what is going to happen here on. You are going to hear from central bankers. You'll probably hear from the Federal Reserve in September. You could see a rate cut. You could see a reversal of this trend. Is this a good time to start lump sum investment or bump up SIPs or start a new SIP?
Yes, Tamanna, see, when we talk about mutual fund, generally, especially in equity, we expect a long-term horizon. Means investors invest with a long-term view. Considering that fact, I'll say that it can be an opportunity for investors. I'll not say that you invest the total amount in a single day, but definitely every dip is an opportunity for investors for investing in mutual funds. But Tamanna, I'll say one thing that considering the recent trend, investors have invested more in small cap, mid cap, and especially in some themes like PSU or defense. And we have been advising this that investors should maintain a balanced portfolio or proper asset allocation. So if investors have more investment or more allocation in small cap or themes like defense and PSU, is the time that they should realign their portfolio with their financial goals and reduce their exposure in these sectors and themes. But yes, they should stay invested.
Okay, so you should stay invested. But, I'll just take that forward to Hemant. The whole rage, two-part rage, one of NFOs, one of thematic funds, and especially in some of the sectors that Pankaj mentioned, defense, infrastructure, all of these themes which have really been running up. Is it the right time for investors to relook and reallocate stick to basically the good old bread and butter, your large cap stocks?
Tamanna, it depends on the kind of investor you are. Look, the fact is that people who have been investing over the last many years have built a decent sized portfolio. They are comfortable with how equity market behaves. They understand the nuances of how equity market functions. Obviously, they reach a stage where they think that they have the risk profile to invest in these kind of funds. I mean, they can be fine, provided, again, of course, the important aspect always is how much exposure do you have to sector and thematic fund. Now, while there are thumb rules which say that 10 to 15% can be invested, but the thumb rule obviously always do not take into consideration your own personal situation. So it depends on, like I said, the kind of investor you are. But for the retail investors, if someone has been investing here thinking that there is an opportunity to make a quick buck, obviously not because there is a correction, even otherwise also, I think there is definitely, I feel that an opportunity or also the time for investors to rethink their strategy as to how much investment they should be having, or if at all they should be having in that. Because my belief always is that if there are certain themes, certain sectors, they have the potential to do well going forward. And if you're invested in well-diversified fund, which have been performing consistently well, surely the fund manager will have exposure to these two or three or four sectors or segment that have the potential. Of course, it may not be as much as you actually can get when you invest directly into those, but they will definitely be participating through this diversified fund. So my point is that not because there is a correction in the market that we need to relook. I feel that for someone who is trying to build a portfolio over a longer period through smaller contribution should always stay away from sector and thematic fund. And if someone has included, surely it's time to kind of relook at that.
But today, what about today and now? It's very timely that we're doing this show today, on the 5th of the month. And people are figuring out what to do. They're probably looking at their portfolios. They're saying that, yes, I have made money over time. And I'm seeing some of those gains, which are still right now notional, evaporating. Do they have to wait? Buy, sell, hold is a very simple, basic kind of a query which viewers have been asking us. And let me put that to you now first, Pankaj.
Yeah, I'd suggest that investors should add or top up their flexi cap fund, or they should add flexi cap funds to their portfolio. And they can book profit from small cap fund, especially even then they have lost some good amount today. But still, I'll say that it's the time that you should book profit from small cap or exit from small cap if you have a large exposure. And flexi cap within diversified category looks better, or large cap index funds can be considered. And if you want to add theme, for example, you do not have exposure to theme, then I'll say that healthcare or consumption, these themes could be better compared to your defense or PSU, because see, thematic funds perform better within a certain period of time. So when we have seen that these themes have outperformed the broader market, so now it's a time that you should exit from those themes and add such themes where you are looking, where you can expect better performance.
Okay, so let me recap that. Very specific and important advice from Pankaj Mathpal. He's saying move from your small cap funds and increase allocation in your flexi cap funds. You can look at large cap funds. If you're keen on thematic funds, then look at healthcare and consumption, which haven't run up as much as others. And remember, it's the recession-proof story, right? So that's why they call the defensives. Hemant, you have similar advice?
Yes, I think, but like I mentioned earlier, I think it's important for investors to realize what will work for them in the long run. If you're making any decision based on what is happening in the market today, trust me, if you see a recovery, if there is a, let's say, unscheduled rate cut by US, and then suddenly if you see a recovery, then the thought process will change again, saying everything is fine now, why should I make a change? So I think it's important not necessarily to look at only the market mood and how the markets are behaving, then make changes. As I mentioned earlier, I think one needs to really look at what will work in the long run. In the long run, for a retail investor, for someone who's trying to build a portfolio, as I mentioned earlier, I think the key is always to go into well-diversified category. And I think that if someone was keen on having exposure to all the three market segments, for example, the multi-cap funds can be great addition. Then there are a large and mid-cap fund and of course the flexi-cap fund. So my view is that like I said earlier, not because there is a correction in the market, but otherwise also I think investors should relook at their portfolio, realign if there is a need, and try to build portfolio with well-diversified fund. And of course, those who have the risk profile, who understand the attendant risk, can obviously have exposure to different markets, different sectors or different themes.
Okay, so keep it steady, hedge your risks, and at the end of the day, remember, it is the domestic investor who's been putting his faith or her faith in mutual funds that has kept Indian markets relatively fine. I mean, I know you're looking at a 600 plus point cut on the Nifty today, and it's seeming painful, but if you compare with what's happening in the rest of the world, it's definitely not that bad. All right, let's take specific queries, and remember, if you want to write into us or you want to ask our experts your questions, the numbers on your screens. Let's start with Piyush Dhule's question. He's 28 and asks that I have 60% exposure to mid-cap and small-cap sectors, but should I reduce the exposure in the current market scenario? Thank you for your question, Piyush, and thank you for watching. Pankaj, let me come to you first for your response. So it's not unusual to have investors like Piyush, and especially he's 28 only, who have a larger exposure to mid and small caps. Do you think it's time to relook at that strategy?
Exactly, Tamanna. Actually, 60% allocation in mid cap and small cap is not a good choice. And now also, Miss, my suggestion, he should reduce exposure from small cap at this moment. If he wants to exit even, that is good. Because we are seeing that small cap have run well, and is the time that should have larger exposure in large cap, flexi cap category, because fund managers have choice. They can allocate funds according to situation. So flexi cap can be a better choice at this moment, but definitely from mid cap and small cap, Piyush should reduce his exposure.
Okay, so reduce your exposure in small cap and mid cap. Anyway, it was not a great idea to have 60% exposure to these sectors. Hemant, what would be your advice for Piyush?
Well, Tamanna, I would say that, look, there are three segments in the market: large cap, mid cap, and small, and all three have an important role to play. Of course, the key is to have them in the right proportion. Now, how do you decide the right proportion? One is to follow a thumb rule, which says that for any investor who's investing over a longer period and who's not very well experienced, should always have a bias towards the large cap. Now, that can be either through pure large cap fund, or it can be through flexi cap fund, or even large and mid cap fund. So that again depends on the kind of investor you are. So I think someone like him, if he's investing for a long term, even then I think the exposure is high. He needs to kind of cut down that exposure. Now that can be done in a phased manner. It need not be done on a single day or immediately. It also depends on whether he's looking to increase his SIP. Now, for example, if he's investing, let's say 10,000 rupees and 6,000 is going into small and mid, and he wants to add another 10,000, he can actually invest that money in the large cap or a flexi cap or a large and mid cap, rather than kind of, stop investing in this. So I think there needs to be some clarity on how you look at your investment process going forward, and what is the size of the investment and how much money are you investing in this, because the percentage does not always give you the right idea.
All right. One more question coming in, and this is from Mahendra, age 36. Asks, is it a good idea to invest in foreign funds right now, given they may consolidate further and could be up for grabs for lower valuation? Excellent question, Mahendra. And Pankaj, this is what I say about the Indian investor who is largely optimistic. I mean, they're looking at an Nvidia, all the mega cap stocks which have been completely liquidating, and saying that I watched these stocks from afar and thought they were out of reach. Are they in reach now? What would be your advice?
Tamanna, adding international funds to your portfolio is a good idea. But at this moment, if somebody wants to invest, I'll say Indian markets are looking better. So have larger exposure in Indian market only, because you do not know the bottom of these funds. So not a good idea to add at this moment these NASDAQ or this kind of funds, especially US market I'm talking about. Better invest in Indian market.
Okay, Ananya has written in, age 35, says, I want to buy the dip, but do not believe mutual funds are the right avenue. So is it a good idea to rely on ETFs to buy the dips? Ananya, excellent question. Thank you for writing in. Hemant, let me come to you first on this. People do want to buy the dip. Ananya's point is a valid one. Why should why should she go through mutual funds, pay that fee? Should she just look at ETFs right now?
Well, I think this is an important question, Tamanna. It's not only because on a particular day you want to buy a dip, and this is the issue that we keep discussing again and again, whether I should go for active fund or passive fund. Again, I think there are pros and cons of investing in both. Of course, there is no doubt about the fact that if you're buying an ETF or an index fund, because there is a cap on the expenses, the costs are lower, right? And of course, there is no human bias because these ETFs and index fund, they track a particular index. So in that sense, yes, I mean, there are advantages of that. But I think, again, there have been occasions, there will be occasions even going forward, where you'll see that actively managed funds, not necessarily maybe in the large cap, but in the small and mid cap, and also those options which give you a mix of different segments can do better. So it clearly depends on, as an investor, whether you want to go in for a passive fund or active fund. But I think both have pros and cons. And also, let's not forget that in the rising market, you may see that the passively managed fund will do better. But in the market, when the market turns choppy, or if you see a steep fall, there is no protection because the index funds have to be fully invested in all time. Whereas in the active fund, the fund manager does have the liberty to kind of keep being in cash for some time. So like I said, there are pros and cons of both. You can always have a portfolio which has a mix of active and passive funds.
But Pankaj, right now, the question is that Ananya wants to buy the dip. To buy the dip, should she look at ETFs?
Not exactly. As Hemant said, I agree with him that ETFs as well as mutual funds, both are important in the portfolio. So at the dip, you can even buy mutual funds, because when you invest in mutual funds and markets are down, the NAV will be low. So that can also be a good choice. So both can be in your portfolio. And the advantage with the actively managed mutual fund is that fund managers, they try to reduce the risk. They try to manage the risk. So that is why you cannot ignore active mutual funds. As you want to build your portfolio, you have space for both the things.
Okay, Manish writes in, age 25, asks, I don't feel much comfort in equity valuations right now. Can you suggest some safer mutual fund bets for someone waiting for a correction? I think, Manish, your question has come to us, or you've sent this question to us before that correction. Having said that, many will argue a 2.5% cut in the Nifty is not really a correction, even in your broader markets. But Hemant, I'll let you field that question first. What are safer bets for someone waiting for a correction? And is that wait now over, or has the correction just started?
No, Tamanna, I think we can't say that the wait is over. I mean, we just discussed that there are global issues right now. We need to really see how the market pans out from here. But if someone is looking at a safer option where the money can be kept and invest in equity at the right time, the question is, what is the right time, whether you're able to time it properly or not. But I think the options would be maybe a liquid fund where the money can be kept, and as and when one feels that there is an opportunity to get in to equity, one can do that. But I think timing that is always very, very difficult. So maybe one way I would say is to kind of do systematic transfer plan, and maybe you can do it on a weekly basis, you can do it on a fortnightly or even monthly basis. And within that, if you see a dip in the market, then maybe you can switch a larger portion of that rather than trying to time in market, because it has happened on so many occasions that investors have been waiting for correction. When the correction does happen, they feel that this will go down further, and suddenly there is a U-turn in the market and they lose the opportunity. So I think timing that can be a bit difficult. STP can be a good option. Like I said, in the process, if you see that there is a fall, try and kind of transfer a larger sum through switch.
Timing the market is actually a losing proposition one way or the other, which is why the good old SIP investors at the end of the day always feel that comfort. Perhaps they're not really crying buckets today like a lot of investors may be. Pankaj, would you agree with that? That it's tough to time the market and wait for a further correction. But the question specifically was, suggest some safer mutual fund bets. What would you reply there?
See, I'll say two options. One, as Hemant said, that one should invest in staggered manner, so STP can be a good choice. Second is, one category is there, which is called Balance Advantage Fund. So this category gives you this opportunity that you invest in one fund, and fund managers, they take a call that how much in equity, how much in debt. So balance advantage fund can be a good choice that you invest your money and leave it on the fund managers. But within this category also, funds are managed differently. So select a fund which has lesser allocation in equity at this moment, like ICICI Prudential Balance Advantage Fund can be a good choice in this category, or Kotak Balance Advantage Fund. So this kind of category can be a good choice. Or if you want lesser risk compared to this even, then there are conservative hybrid funds or equity savings fund. These kind of categories can be considered.
Okay. So you have to look at various categories at this time, and STP is a good idea because tough to time a correction. It could be today, it could not be today. I mean, you will hear people saying with complete confidence that this is just the beginning. If things turn by tomorrow, then they're not going to be really able to tell them anything. Let's take this question from Sahara Nagraj. Says they've received a security deposit of 12,000 rupees, looking to invest this amount into mutual funds. Where can I invest in? Let me just add one bit to that question and take it to Pankaj first. If Sahara was sitting today with this 12,000 rupees, would you say deploy the cash today or stagger it over the next few days?
Again, it depends that how much money he has already invested, means his portfolio size. But if somebody wants to build a portfolio now and the horizon is longer, this amount can be invested in one go today.
Okay, can be invested in one go today. That's interesting. Hemant, someone sitting with a bit of money and anyway looking to deploy, today is a good day?
Well, today is a good day, but we don't know whether it's stopping here or the correction will continue. It should be that tomorrow you start feeling that, okay, I kind of acted very fast. So again, you can stagger it. Like I said earlier, it's very, very difficult to time it to perfection. Maybe if you want to invest 100 rupees, maybe 30, 40 rupees, you can begin investing and then maybe wait and see how the market pans out. But in this particular case, if he's saying he has a security deposit of 12,000, I don't know if he has to kind of refund it after a year or what is the time horizon. I think all that is important. So even if the market presents a great opportunity, if the time horizon is not long enough, I would say stay out.
Yeah, but I mean, at the end of the day, they already want to deploy that 12,000 rupees. The question is about whether they should do it now and at one go. If you have a longer term perspective, then there's no harm in doing that, because trying to time the exact bottom of any market is near impossible and maybe a fool's chore. But steady and slow does win the race and will continue to do so even on a day like today. Thank you so much, Pankaj. Thank you so much, Hemant, for joining us. Thank you for all of our viewers who've tuned in. If you have a question for us, those WhatsApp numbers are on your screen. Until we see you today, same time, same place. That's all the time we have on the Mutual Fund Show. But stay tuned, a lot more coming up on the other side on NDTV Profit.